Amazon is trading close to its all-time high at $184 per share. The stock is up 23% year to date after soaring 75% in 2023. So, is it too late to join the rally, or could Amazon still be undervalued despite its impressive recent performance? In this video, we will answer this question by analyzing the Amazon stock, determining its intrinsic value based on our valuation models, and deciding on an acceptable buy price with a reasonable margin of safety. Now, for this video, we'll do something a bit different than my usual stock analysis videos. I'll be using a software called FastGraphs, which is a fundamentals analysis software that provides visual historical graphs and forecasting calculators, which together can help us see how the stock is performing compared to its historical averages. I do also want to clarify that this is not an in-depth stock analysis, but rather a quick valuation and review to determine if Amazon looks like an interesting buy today, which is part of a new series on this channel. If it does look like an attractive buy, we can then proceed with a more detailed analysis looking at the company's financial performance, risks, opportunities, and so on. This will highly depend on your interest, so make sure to let me know in the comments below if you would like me to make an in-depth stock analysis for Amazon. Also, make sure to watch until the end so you don't miss any of our different valuation techniques that we will use today. And by the way, this video is not sponsored by FastGraphs and I'm not affiliated with the company whatsoever. I'm just sharing with you one of the tools that I use for stock analysis and valuation for the sake of knowledge sharing, and maybe someone will find it helpful. With that being said, let's get right into it. First things first, let's start with a quick tour of FastGraphs, just in case you've never used it before. On the top right here, we have the most recent closing price, which is $184, the blended PE, which is based on a weighted average of the most recent actual or estimated value, and the next forecast value. It's basically the software's effort to provide a more accurate estimate of the current PE instead of just using the standard trailing 12 months or the forward PE. While I do like the idea behind the blended PE, I do want to remind you that the PE by itself is not really a good valuation metric. It needs to be used in conjunction with other metrics to provide a more accurate valuation. And as we can see here, Amazon's blended PE is currently 50.9. We also have the earnings per share yield, which is currently quite low at 1.96%. And Amazon does not pay a dividend, but if you're analyzing a dividend stock, the dividend yield would appear here. Now, the orange line that you see on the chart is a fair value estimate based on Benjamin Graham's famous Graham-Dodd formula. Without getting into too much detail, all you need to know is that if the company's earnings growth rate is lower than or equal to 15%, the orange line will reflect a 15 PE. If the growth rate is anything higher than 15%, the orange line will match the rate of growth. For example, since 2003, Amazon has been growing operating earnings at 27%, which is higher than the 15% threshold. So the fair value ratio will match that at 27 as well. We can also confirm that by hovering over any point on the orange line on the graph, and we'll also see the 27 PE. The blue line, on the other hand, is the normal PE ratio that the market has typically applied to the stock over a specific period of time. As we can see here, Amazon's normal PE ratio is 119.4, which means that on average, since 2003, investors have been willing to pay 119 times earnings to buy the stock. This is obviously a very high number, but with good reason. For many years, Amazon prioritized business expansion and reinvested its profits into the business, which meant that earnings remained compressed. Therefore, valuing Amazon based on earnings could be very misleading. The best metric to value Amazon is operating cash flow, as it provides a more accurate picture of the cash generated by Amazon's business operations. However, before we move on to operating cash flow, I want you to notice how the stock price, which is the black line, moves with the orange and blue lines. When earnings increase, the stock price goes up, and when earnings decrease, as in 2022 here, the stock price falls. But even though they move together, the correlation does not seem very strong. Now, if you change the analysis metric to operating cash flow, and by the way, you can see here all the other available metrics like basic earnings, GAAP diluted earnings, operating and free cash flow, as well as EBITDA, EBIT, and sales, but those last three are only available in the premium membership. I personally use the basic membership, so I don't have access to them. Anyways, let's see operating cash flow. Notice how the price line very closely tracks both valuation lines. This implies that there is a very strong correlation between the stock price and Amazon's operating cash flow, which suggests that this metric is a more reliable metric for valuing Amazon stock compared to earnings, which we saw before. Now, anything under the blue and orange lines implies that the stock is undervalued. If the stock price is higher, then that would suggest that the stock looks overvalued. If we use this timeline since 2003, Amazon's operating cash flow grew on average 29.1% per year, and investors were willing to pay 25.5 times operating cash flow to buy the stock. Amazon is currently trading at a blended price to operating cash flow of 19.1, which is lower than the normal and fair value ratios, suggesting that the stock is currently undervalued. This also translates to a 5.2% operating cash flow yield, which is not bad for Amazon. But what if we change the timeline? What if we only look at the last 10 years? So I'll go here and just select 10 years. This includes 2025 and 2026, so let me just adjust that quickly to include only the last 10 years. So when we decrease the time frame to the last 10 years, the normal price to operating cash flow decreased slightly to 24.3, while the growth rate actually increased to 31.7%, which means that even though Amazon grew its operating cash flow at a faster pace in the last 10 years, investors were only willing to pay 24.3 times operating cash flow compared to 25.5, which we saw earlier. The other thing I want to point out is the fair value ratio, which represents the orange line. You'll see here that it shows 30 despite the growth rate being higher than that. The reason is it's capped at 30. So even if the company is growing at a higher rate, the fair value will always stop at 30. So back to the chart, we can see that the black price line is currently under the blue and orange line, meaning that Amazon is currently trading lower than its 10-year average price to operating cash flow. If we look at the last 5 years, we'll see the exact same thing. Again, the current price to operating cash flow is lower than the normal and fair value ratios. So all in all, based on historical averages, Amazon does look like an undervalued buy today. Now, before moving on to our valuation models, let me show you another cool feature available in FastGraphs, which is the forecasting calculator. You can choose here which forecasting method you want to use. I usually prefer to use the normal multiple because I think it provides a more accurate picture of how the market likes to value the stock. But sometimes it also makes sense to look at the fair value estimate, which is the orange line. You can also do long-term forecasts up to 2029, or forecast based on the stock's historical CAGR. Finally, you can customize your own forecasting estimate by inputting your own assumptions. I personally haven't tried this one out yet, but it is available if you prefer to use your own inputs. Anyways, going back to the normal multiple forecast, you can see here that we're still forecasting based on the operating cash flow metric, and I'll just change the historical ratio to 10 years. Down here, you'll see the analyst estimates for operating cash flow up to 2026, as well as the number of analysts. If I click here at the end of the forecasted period, we'll see the expected total return for the stock, as well as the total annual return. This basically means that if the stock trades at its 10-year average price to operating cash flow of 25.3 in 2026, the total return will be 130.7%. with a whopping 38.5% annual return. That's over 3 times the average return of the S&P 500. Now let's be a little bit more conservative and use the 5-year price to operating cash flow, which is a bit lower. Again, we see a significant upside with 111% total return and a 33.7% annual return. Let's also quickly look at the stock's long-term return potential. As you can see here, analysts are expecting a 26.1% annual increase in Amazon's operating cash flow until 2029. The average fair value ratio shows here 26.1. If we forecast Amazon to trade at the same ratio in 2029, this would imply a whopping 31.6% annual return and a 361% total return. Obviously, this is an amazing return on your investment today, but as you know, I prefer to be more conservative than that. At the bottom of the 2022 stock market drop, the Amazon stock traded at an 18.3 price to operating cash flow, even lower than the COVID-19 crash, which was closer to 20, I think, at the bottom. So let's say the stock returned to these lows in 2029, for whatever reason. An investment today would generate an impressive 23.4% annual return with an estimate stock price of $595 per share. Honestly, I was a bit surprised to see these numbers, especially how expensive the market looks today compared to historical averages. However, as always, despite the observed undervaluation, we should not look at any metric in isolation, and will only make conclusions by the end of the video. Moving on to our valuation models, there are 4 distinct valuation methods that I usually use. These are the discounted free cash flow model, the multiples valuation model, the dividend discount model, and the historical multiples valuation model. However, for Amazon, only two of these methods apply: the discounted free cash flow model and the historical multiples valuation model. So we'll focus on these two. If you would like a copy of these valuation models to value any of your preferred stocks, you can now get one from the link in the description below, which will include all four models. And if you're enjoying the content so far, please smash the like button and subscribe to the channel to ensure that you're notified when similar videos are released in the future. As you probably know, every investment is the present value of all future cash flows, so it would only make sense to start with a discounted free cash flow model, where we estimate Amazon's intrinsic value based on the present value of their estimated future free cash flows. We can see here the free cash flow that Amazon generated over the last 10 years, growing at an average 65% per year. As we saw earlier, analysts are estimating cash flows to grow at 26.1%, but I chose to be a little bit more conservative and go with a 25% growth rate for future cash flows. Using a 9% discount rate, which is the minimum that I use for pure growth stocks, we get the present value of all future free cash flow as well as our terminal value. Adding them together, plus cash and cash equivalents minus total debt, we get our enterprise value, which is the estimated total value of the company. Dividing the enterprise value by the total shares outstanding, we get a fair value of $221 per share, which is higher than Amazon's current stock price, indicating possible undervaluation. The second method that we will review today is the historical multiples valuation model, where we estimate Amazon's fair value by considering the normal price to operating cash flow ratios that the stock traded at historically. In our analysis, we'll use the 5, 10, and 20 years normal price to operating cash flows. As we saw earlier, the Amazon stock was trading at an average 22.7 price to operating cash flow during the last 5 years, 24.3 in the last 10 years, and 24.9 in the last 20 years. We calculate their average and multiply it by Amazon's current operating cash flow per share to get our fair value of $256 per share, also higher than the current stock price. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the two fair value estimates generated by our models. The intrinsic value we get is $239 per share, which is much higher than the stock's current price and higher than its 52-week high. Without a margin of safety, the stock would be a buy at the current price. However, we always want to have a margin of safety to protect against downside risk. For high-quality companies with a wide moat, strong balance sheet, and good forward-looking data, a 10% margin of safety could be justified. With a 10% margin of safety, our acceptable buy price would be $215. For a 15% margin of safety, the acceptable buy price would be $203. And for a 20% margin of safety, it would be $191 per share. So as you can see, Amazon does look to be undervalued as the FastGraphs tool suggested. Even with a 20% margin of safety, it looks to be a buy today. In terms of Wall Street's expectations for Amazon stock, they are forecasting it to trade at $221 per share in 12 months, which is a little bit lower than our estimated intrinsic value, but higher than the current stock price, implying a 20% potential upside from current levels. As always, please remember that this is not personalized financial or investment advice. I have no idea what your personal situation or investment timeline is, so please decide yourself whether you agree with this valuation methodology or assumptions used in this video, and make sure to do your own research before making any investment decisions. With that being said, I really hope you found this analysis beneficial. Let me know in the comments below if you would like me to make an in-depth stock analysis video for Amazon. And if you enjoyed this analysis, don't forget to like and subscribe. Thank you very much for watching. Until next time.